What's up, guys? It's Mr. Fit to Flourish. I got tired of watching my Colorado Buffs lose this football game to Nebraska, the Cornhuskers, so I thought I'd get on and talk about some options today. So we have an options masterclass in the Discord tomorrow, so I thought I'd come on and sort of just give a brief overview of options and how they work, just for beginners, because you can make options extremely simple, okay? So options made simple. Let's make this a little bit bigger. So first, to understand options, we need to know what a stock is. So what is a stock? A stock is an equity or a security measured in units called shares. Owning a share is like a ticket that represents ownership of a piece of a business. Stocks are traded in a stock exchange or stock market. And they're also often referred to as the underlying. Now, what's an option? So the complicated version is a contract on a stock, so it's like buying insurance on a house, and it gives you the right but not the obligation to buy or sell an asset at a fixed price at a predetermined future date. Okay, so this is the definition we get a lot of the time, but let's make this a little bit more simple. Options are derivatives, okay, so they come from the underlying asset, etc., but let's make this a little bit simpler, okay? A little bit simpler. So options are just a bet. Okay, they're just a bet. And what are we betting on? So if you're getting calls, you're betting that the stock price is going to be going up. If you're getting puts, you're basically betting that the stock is going down. That is literally all that options are. Okay, they're just a bet that the stock is going up or the stock is going down. Now, when you're buying options, you're going to see that the price is represented in like these penny dollar amounts. Looks kind of weird. But what's happening is you're actually going to pay what's called a premium. Okay, you're going to pay a premium. So you multiply 0.13 by 100, which is the option multiplier. And you're actually going to be paying $13 for the contract. So every contract gives you control over 100 shares. So who cares? Don't worry about what that means, because you're not going to use it at all. You're not going to use it, so who cares? People say this all the time. Doesn't matter. What you need to understand is when you see 0.13 multiplied by 100, that's how much you're paying for the contract. Okay. People get too into the nitty gritty. You don't need to until you get to advanced level trading. Don't worry about that. All you need to worry about is, hey, $13 is what I'm paying for my contract. That better go up. Okay, so if the trade starts to go in the direction that you're betting on, so if you get calls and the stock starts to go up, then the contract price will go up too. So if you pay $13 for a contract and the contract or the stock starts to move up, then your contract will move up. So it'll be like 13 will go to 15, and then that'll go to 20, then that'll go to 30. So your contract price is going to gain value. And as soon as it gains as much value as you like, so if the 13 goes to 26, which is 100%, then you could sell it. You sell it, okay? You don't have to hit a strike price or anything like that people really don't understand. You don't have to hit anything. When the contract is making money, you sell it when you want to, okay? And what is that premium? That premium, it's the price of an option, okay? It's the price of an option. And the basic formula for a premium is just intrinsic and extrinsic value. So premiums consist of extrinsic and intrinsic value. And basically the extrinsic part is what makes a large part of some of these options, a lot of their value. So the value is in the amount of time till the option expires and the volatility. So something that's more volatile is going to be a stock that's usually fluctuating in price quite a bit, or being highly traded, or has huge news or a lot of hype around it. Okay, out of the money options typically have no value, or they actually have no value. So they only have extrinsic value. Now, in the money options have intrinsic value because they can be turned in for stocks. All right, so options further explained. So what is the strike price? So the strike price is the predetermined price that your option can be exercised. And then exercising an option just means that you're using the option contract to buy or sell the stock at the agreed upon price. Options typically have expiration dates and they land on Fridays. However, if you're trading QQQ or SPY or some of these ETFs, they have same day expiration options that pretty much go Monday through Friday. Okay. Again, a call option is when you think the stock is going to go up. It's a bet that the stock is going up. And then a put is a bet that the stock is going down. So a lot of people don't understand you can make money when stocks go down. People just sell and then they just sit back and wait to buy again. No. Get in the freaking options market and make money as the stock is going down. Or you could short stocks if you understand stocks. But still, you're gonna have to use a ton of money, ton of capital, as opposed to options, which allows leverage. Okay. So all options expire, and the closer you get to the option's expiration date, the less valuable the option becomes. Options always expire worthless. Okay, they expire worthless unless you exercise the option, which we could talk about in another video of how to do and what the math looks like. But people typically sell their contracts once it becomes more valuable. So time value. So the more time your option has to reach the strike price, then the more expensive it's going to make the contract. And something I did want to show too was the nomenclature. So for instance, let's say we're getting calls. Over here on the left hand side, make this a little bit bigger. On the left hand side, you could see it's the stock price, and then on the right is the option price for each associated stock price, okay, at each strike. So currently, let's say that currently this stock is trading at $43. So this is called at the money. At the money. Now, if the stock is trading at a price that is higher than a stock price that the option price is at, then that's in the money. So 43 is where the current stock price is at. So 40, 41, if you buy options in these areas, you're in the money. Those options are in the money. Stock prices that are out of the money are prices that the stock has not reached yet. So when we're getting calls, you might get a strike price. You might get again a $13 option with the strike price of $45. So you're betting that the stock is going to be moving towards $45. So that's an out of the money contract. A lot of people like to get calls. I like to get puts. All right. And then a couple things. So in terms of option Greeks, so option Greeks are what makes up your contract price. So one thing to understand is delta. Delta is one of the Greeks, and it tells you how much your option value will increase or decrease with the $1 change in the underlying or in your stock price. So if your stock increases $1, your delta tells you how much your contract is going to increase. So this is a really good gauge of which contracts to pick, because you can always tell, like, oh, okay, this one's going to increase by this much, this one will increase by this much, and you could tell how much money you'll make right off the bat before you even purchase the option contract. So here's a really good example of delta. So delta in action. So let's say that you buy a call option for $50 or 0.5, and the delta is 0.25 or $25. So your delta is 50% of your call option, of your premium. That's actually really good. So if the stock price is $100 and then the stock goes from 100 to 101, well, delta is 25. So delta tells me how much my contract, which I bought for $50, how much it'll gain each time. So we bought the contract at $50 when the stock was 100, and then the stock went to 101, and now my contract is worth $75. So that's a 50% increase after a dollar move. That is insane. So let's say that instead of just one contract for $50, let's say I bought 1,000 contracts for $5,000. Okay, so after a $1 move in the stock price, my $5,000 contract would go to $7,500. And then after an additional dollar move, that $5,000 now turns into $10,000, 100%. And this is a very real move. This happens every single day. Okay? Every single day in the stock market. So that's why trading options is absolutely amazing. Just for a $1 move, you can make $10,000. So to make $10,000 off of this stock, you would have to buy a ridiculous amount of shares for $100 each, like a ridiculous amount of shares. And then it would only go up. So if you bought $100,000 worth of this stock, which would be 1,000 shares, after you get a dollar move, that 100,000 would go to 101,000, which means you only made 1,000. But risking only $5,000, you can go up 2,500, 2,500 off of a $1 move in the underlying. And that's pretty much the concept I wanted to kind of show today in terms of trading options and what options are. It's just a bet. You're buying contracts that are betting on the direction of a stock. So it's betting on directionality using leverage. And what leverage really means is small amount in for a large amount out. And that last example really shows how you can make a ton of money using very little money, so very little capital. So you might be trading with $100,000 and then the stock goes up $1, you only make $1,000. Well, with $5,000 on an option, you can make $2,500 just only using 5,000. So very little capital, like I said. Again, options they're wasting assets, which means that they do expire. So that 5,000 can go to zero, and they're very risky. So this is not financial advice or anything like that. This is just kind of opening your eyes to a lot of the instruments that are available in terms of the markets, equities, assets, and derivatives. Okay, so it's not just stocks. It's not just futures, crypto, Forex. Options are pretty cool. But anyways, that's all I had for you today. This is very basic info. We can go deeper on the next video. But it's your boy, Mr. Fit to Flourish. I'm out. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.